volatility is a way to determine how risky it might be to participate in the market. Hey, welcome back, traders. This is part 5 of Options 101. We're going to take a look at volatility and how volatility has an impact on those options contracts. I had mentioned volatility and implied volatility. We'll discuss that specifically in this part, but I'd mentioned that in the previous part, so I wanted to dedicate an entire part of this course to volatility because of how important it is and what a big impact it has on the price of options. And since we are options traders, I think that's something you should be aware of and have a basic understanding going into the strategy courses of how it can change the price of an option. So again, we're on part 5 on volatility. This is our disclaimer. Feel free to pause and read if necessary. Let's get started. So first, I want to talk a little bit about volatility and use it in our insurance example. Previously in this course, we related options contracts to insurance policies. So I thought I'd kind of bring that back around for a second and think about travel insurance. All right, let's say a family of 4 is going to take a vacation and they have a couple of options for destinations and they're going to a travel insurance company to get some insurance for their vacation. Destination number 1 is British Columbia, Vancouver, British Columbia in Canada. And destination number 2 is Kabul, Afghanistan. Beautiful snowy mountains in the background. Both seem very metropolitan. But which do you think would be a safer location versus a riskier location? Which location do you think they would pay more for their travel insurance? So when things are riskier, this is the point I'm trying to make, when there's a riskier situation, the insurance costs more. And if we can relate to those insurance premiums to options premium, you can see why when we're looking at a stock or an ETF or the marketplace as a whole, when things are a little riskier or scarier in the market, the premium for an options contract goes up because it's a much more risky investment. So let's dive into where it comes from. Volatility in the marketplace can come from earnings events. Companies are having a bad year overall, and we go through these earnings reports that they come out and say how things are looking. They announce this to the general public. If things are good, that's a good thing. If things are bad, that's not a good thing. But in general, around those earnings announcements, the volatility of a stock will go up. And there are certain times a year where specific companies that are a larger portion of the market will all announce their earnings kind of within the same time frame, pretty close time frame, and so the overall market volatility will increase because of that. Analysts might downgrade the rating or even upgrade a rating, which should change volatility. The company could announce some bad news, a product, or there's some type of event happening that it's a good event, a good product, bad product. The Federal Reserve has an impact on market volatility. They could announce things like rate changes, economic policy changes, things of that nature, and then economic reports. There are economic reports that are released at various times of the year regarding consumer prices, inflation, economic reports around employment numbers, unemployment numbers. So things of that nature can also have a positive or negative impact on the market, changing the market volatility. And then finally, political events, geopolitical events, global events, unforeseen events that might come about and just happen because they happen. Those can also change the overall volatility of the marketplace. So where do we find this volatility? The premium increases or decreases based on the overall volatility of the market, right? Because if it's a higher risk, if something's a higher risk investment, that's going to be more volatile to your money, to your balance, to your account. So you're going to have to pay more for those options premiums, or the people who buy them, the premiums increase, versus something that's a more stable or less risky investment. The premiums are lower. It's not going to cost as much to purchase that insurance, for the safer destination, similar to a stock or an ETF that has a lower volatility rating. It's a safer investment. Individual underlying asset volatility can also fluctuate at various times. There can be little anomalies that come up and cause the volatility of a stock or an ETF to change for some reason. But a few general trends we're going to look at. I'll show you some examples of the individual as well as this general trend. In general, the volatility of a stock will increase when its price is decreasing. And if you think about it, if something's price is going down per share, their stock value is dropping, you're not going to want to invest into that. That's a volatile or a risky asset to invest in. You could lose money. So that's why its volatility increases. And when a stock, its price is going up, well, that's a less risky asset to invest in. You possibly make some more money. It's looking pretty good. Things are heading in the right direction. So its volatility will decrease when that happens because it's just not as risky as other assets. All right, just a moment ago, I said, where do we find this volatility information? So one of the places we can look just to kind of gauge the overall market volatility, this is a very common way for traders to do this, is a ticker symbol called VIX, the VIX, the Market Volatility Index. And this tracks the overall index of the S&P 500, the 500 biggest stocks in the S&P. And we can look at this just to get a general trend for what's happening in the overall market. Not necessarily stock to stock or ETF to ETF, but from an overall perspective, like the 30,000 cruising altitude perspective, you get an idea of what's going on in the market. You can see when the overall market volatility is going up, when it's going down, when it's just hanging out at a certain level. So this is a good place to look for just kind of general overall market volatility. Now, there are two types of volatility I want to get into. In my previous part, we talked about implied volatility, but I want to compare that to historical volatility. And both of these are used as a way to gauge how safe or risky it is to invest or trade in a specific company. So first, let's start with historical volatility. Historical volatility uses price information such as previous daily highs and lows, closing prices from day to day, how much is the price of that underlying changing on a daily basis, how big are the price swings on a daily basis, and you can use that as a way to determine how volatile it is. An example would be, let's say we have a stock that normally goes up or down about $4 per day. That's its range. The high and the low, the difference between those two is on average about $4 a day. And then all of a sudden, within the last couple of weeks, those price swings on a daily basis are more like $8 to $10 per day. Something's going on. That stock's a little bit more volatile, actually a lot more volatile. So that's something to look out for and be aware of when you're looking at stocks to trade options around. And so traders will use this historical information to determine whether we should expect volatility to continue to increase or if it's starting to decrease. If we see the opposite happening, it goes from swings of $8 to $10 per day and starts decreasing, $5 to $6 a day and then back to $4 a day. So things are kind of calming down. It's less volatile. All right. Some trading applications do have indicators to look at historical volatility. And so I want to go take a look at one. I took a screenshot of one so we can see what that looks like and point a few things out for you. So we're back to that Thinkorswim application. And I took a screenshot of the Apple stock and I asked Thinkorswim to put up a historical volatility chart. And so you can, I'm going to point out a few things to you here. So those generalizations, when prices are decreasing, you can see on the left-hand side of this chart, Apple prices starting to drop, and then you can see its historical volatility is starting to rise. So it's becoming a riskier investment, prices going down, the volatility is increasing because of that. And then conversely, if we look off to the right side, as Apple's stock starts to steadily go up, you can see that the historical volatility is decreasing overall. So those are just two general trends that you can look at. Second would be around specific announcements like earnings. These little symbols here, the phone call and the light bulb, that indicates that we're having an earnings announcement. And you can see around each one, there's this little uptick. There's the earnings there, a little uptick in volatility. Earnings event, little uptick there. Earnings event, little uptick. So volatility tends to go up right before some type of an earnings announcement. People are getting a little nervous. What happens if they say something bad? That kind of thing. So you can see there are changes in volatility around specific events. And I just thought I'd point that out. So that's historic volatility. Now let's take a look at implied volatility. Implied volatility is more of a forward-looking metric. What are we implying is going to happen in the future? Are there specific events on the horizon that we think is going to cause that product to be a little riskier? And so we anticipate those events happening. We anticipate that it's going to make a more volatile environment for us to invest in. And so the stock market prices that volatility into the options, right? It's riskier. We're going on a riskier vacation. It's going to be, or we're going on vacation in the Caribbean during hurricane seasons versus non-hurricane season. You're going to have to pay more for the insurance, that kind of thing. This implied volatility gives us kind of a glimpse. It's not a perfect crystal ball, of course not, but just a rough estimate of what to expect in the market. So where do we find implied volatility? Again, back to Thinkorswim, took a screenshot of the options chain. And when you're in the options chain, it's specifically in Thinkorswim, I'd have to go back. I know some other trading platforms have it as well. Again, maybe look into your broker's platform. Off to the right-hand side here, you'll see these percentages, and these percentages represent the implied volatility percentage. If you look at some of these percentages here, like let's take a look at these first three, you'll see that within the week that I took this screenshot, the implied volatility is in the 20th percentile, 19.5. Again, just going up a little bit, 20.7, but then this big jump, like a 6% jump in volatility. Well, why is that happening? Oh, that's right. Apple is reporting earnings August 3rd, and this contract is set to expire the day after. So if you were to get into an options contract prior to then, that could be a risky venture. You know, Apple's going to announce earnings while you have that contract open. That could be a good or bad thing. We're not really sure, but the market is saying, hey, that's a riskier investment for you. And they're telling you so by giving you the implied volatility. One other thing I want to show you is the difference between two different products. I'm going to go to my live trading application here, and I pulled up a couple of different tickers that I want to take a look at and look at the implied volatility of those. So let me switch over to my live thinkorswim here. There we go. And so I'm going to take a look at Apple. I've got a stock list over here, and here's Apple stock. And a lot of these applications will have the ability to have an implied volatility column. It'll just tell you not just the column over here within the options chain, but within the watch list, just an overall volatility of that stock. And so I'm taking a look at Apple. If you look here, Apple's got about a 25.71% implied volatility. And so let's go take a look at Apple options. I'm going to go to this expiration date, September 15th. It's about 26 days to expiration. And if I look at some of these at the money options, right, Apple's trading for close to 175, right? So if I look at the 175 strike, we would expect to have options that cost around $400, $4.20, $4.30, $4, $4.10. So multiply that times 100, you get around $400. If we go to another stock, a way more volatile stock, I found this one here. It's called FSLR. That stands for First Solar. They're a solar energy company. You can see that their implied volatility is over 50%. That's twice, almost, well, more than twice of what Apple's implied volatility is. So this is a much more risky investment for investors, and we can tell because it's much more volatile. And in fact, if we go over here and look at the at-the-money options for the same expiration, and keep in mind that the price isn't that much different. There's just about a $6 difference. We're looking at $835, $850, $1,000. So much higher premiums for this riskier investment just because of the volatility. So this is another example of how volatility can play into options premiums. And then, you know, in the strategy courses, we talk more in depth about how to use these numbers to our advantage and build a sound strategy around those. So let's wrap it up. Let me go back to our slideshow here and wrap it up for this part. Volatility is a way to determine how risky it might be to participate in the market. You know, whether you're buying or shares, selling options as we do, you know, it's something we want to be cognizant of and make sure we're aware of how volatile things are when we're in the marketplace. There are indicators we can use for this: historical volatility, implied volatility, to help make us better informed traders. And then just know that there are specific events we look out for that can cause a spike in that volatility. All right, so this has been our volatility lesson. Thank you very much. We'll see you in part 6.